Welcome to Real Vision Crypto. I'm Ash Bennington. I'm joined today by Mike Rogers, head of crowdfunding at Securitize, for a deep dive on Web3. Mike, welcome back to Real Vision.
Thanks, Ash. It's great to be here. I always love being on Real Vision with you.
Well, it's a pleasure to have you back. I know you've been working on a presentation around Web3 and crowdfunding. Mike, give us a little bit of context on what you're working on and why you think it's important.
Well, it's really important because it comes down to the concept of digital transformation and what that has allowed for over the past 40-ish years when it comes to the creation of new business models as well as industries. So if you look at one of the first presentation slides that we have on what digital transformation has allowed for in the past, you could see what it did with the music industry, how we went from vinyl recordings to CDs to MP3s. And then what really became transformational was music e-commerce, the ability to stream and have data-driven playlists. Think about the major companies today, like Apple and Spotify, when it comes to music. It really revolutionized everything. When you look at what's going on in the public markets over the past 40-ish years, we went from paper certificates to dematerialized certificates to electronic trading with NASDAQ, and most recently, as everybody is well aware, with Robinhood and the meme stocks. But realistically, what Robinhood allowed for was the democratization of access to financial instruments to everybody that has a mobile device. Unfortunately, the private securities market really hasn't seen any digital transformation when it comes to materiality over these past 40 years. And that's where we at Securitize believe that Web3 technologies, and specifically blockchain, can help with digital transformation of the private securities market.
So what's interesting to me about this slide as I look at it is that for the top two horizontal lines, the music industry and the public securities industry, basically we've seen all four of those bubbles to the right take place. We've gone through this process from from records to CDs to MP3s to this digitized cloud-based SaaS space for music, e-commerce, and streaming. So too on public markets, you see that change from paper certificates, dematerialized securities, electronic trading, and now the next gen trading apps of the Robinhood ilk. But as we look at the private markets, this transformation is in many ways sort of stalled or stuck in a very much a nascent phase. This business is conducted, I think, on Sand Hill Road, for example, out in Silicon Valley, in many ways, precisely in the same fashion that it was conducted in the 1990s. People have iPhones now and maybe cooler haircuts. But the idea of the basis of the business really does seem to be very much an analog one.
Well, I really am quite pleased that you brought up Sand Hill Road because Andreessen Horowitz, Mark Andreessen, and Chris Dixon, they help with spreading a lot of these logical frameworks. And one of the things that they wrote was a book called Secrets of Sand Hill Road. And it's funny, doing research for this presentation and how to build out our business line, what they said at the very end of the book was that there are two things that can really potentially put venture capital out of business. And you're going to laugh when I say this, but one of them was actually crowdfunding, and they were citing statistics from 2017 with the $1 billion that was raised, because you have to remember, this comes from the Jobs Act, and the Jobs Act is really actually younger than Bitcoin, because Bitcoin was created in 2009, 2010, and the Jobs Act was passed in 2012. So this small amount of capital, similar to Bitcoin with the network usage, it's going to grow exponentially, and we've already seen that. That was one of the things that they cited, crowdfunding. The other one was initial coin offerings. Looking back on that, they were deemed non-regulatory compliant, but that's actually where Securitize comes into play with digital asset securities and security token offerings. And we're combining the two. We're combining crowdfunding and digital asset securities offerings. We're digitizing the private capital market capital raising process as well as secondary market trading.
Yeah, I mean, I should probably say, in all fairness, obviously there are people who are raising money using digital assets, but the divide between the regulated capital raise based on the private market side and the digital asset raise crypto world stuff is still pretty stark.
Without a doubt, I mean, it's early days, but the thing is, you have to look at what you get when you're raising capital. And those that we're working with right now for this business line, which we've really been building out over the past several months, they have options for raising capital, but a lot of them have had a bad taste in their mouth with venture capital in the past because, as they say in Secrets of Sand Hill Road, it's really a marriage between yourself and those that you are raising capital from, specifically if it's a venture capitalist. Andreessen says it in that book that they have the upper hand because they analyze hundreds and thousands of deals. And when you are an entrepreneur, you have your targeted focus on your one baby. So they have the upper hand when it comes to negotiating term sheets. And term sheet, it's right in the name, linguistically. Terms and conditions. You're giving up a lot of the times your governance power. You're giving up board seats. You're giving up maybe more control than you would like. And what are you getting? You're getting capital. But capital, as we know, the reason why Real Vision exists, the reason why private equity, where I came from before coming into digital assets full time, has been growing at such a rapid rate, is that the world is awash in capital. It's been awash in capital since, you're a student of the markets, Ash. What global savings glut? How many Fed chairs ago was that one? So think about how much more capital there is as we've kind of been expanding money supplies over the past several decades, and most recently as well. The world is awash in capital, but what you don't get when you're just getting capital, you have to still go out there and hire developers to build your products and applications, and you still need to get users. The beauty of the Web3 crowdfunding solution is that you're killing two birds with one stone. You're getting both. And not only that, you're rewarding those that support you, your community members.
Talking of capital and value creation, I found this next slide fascinating because this is really a secular trend that we've been seeing in markets now for decades. Walk us through what we're seeing here, Mike.
Yeah, so Securitize did a study, the brain trust and the leadership here, which is fantastic, by the way. I just have to give a shout out to our co-founders, Carlos Domingo and Jamie Finn. I've known them for several years now, and what's great about Web3 and community based, I didn't meet them in person until September when I was hired by the company. So that's just kind of speaks to what communities are being built online and what we're capable of doing. You don't need to be in the same physical presence. And I think that this slide right here really shows that these Web2 platforms that have brought us all together have not created the value for their stakeholders that some of the other Web1 and internet companies that built out the foundation, such as Apple, Microsoft, and Amazon, there was a lot of opportunity there for the public because they didn't go public at such high valuations. There was a lot of potential for growth. Now we've seen, and really you could see right in the middle there, Google, which is kind of a mix between a Web 1 and a Web 2 company. That was kind of the turning point because you could still get a pretty good return there. I mean, 66x, nothing to sneeze at, right? But when you're looking at compared to the over 2000x and 4000x of Microsoft and Amazon versus, say, the FANG stocks, specifically we're all on crypto Twitter. I'm sure that this is going to be on there. There wasn't much of a return for Twitter or Facebook. A lot of it was really for accredited investors and venture capitalists and those that can access these markets. And what we want to do is we want to increase access for these markets. And we're doing it in a regulatory compliant way by using the regulatory exemptions that were afforded to us by the Jobs Act.
Yeah, I just want to double click on this for people who are relatively new to the private market space and to thinking about this in this context. Pretty extraordinary when you look at something like Airbnb on the right, going public in 2020. The idea that you basically, if you were a really savvy investor, you believed in Airbnb, you followed the story, you doubled your money, which was great. By the way, this is selection bias. You might have missed if you'd picked the wrong stock just as easily as if you'd picked the right one, you'd succeeded. But the idea that you saw a 6,800x return for investors early on in the private markets, you see with Microsoft, for example, a 4,000 plus x return if you were fortunate enough to pick the right stock. But it does sort of give you this sense that public markets, in addition to being very difficult to pick winners, when you do pick the winners, the rate of return has just decreased by many orders of magnitude.
It's not even a question. And that's actually where we see the parallel between the Web 1 companies and the returns that we've seen with open source protocols like Ethereum and Bitcoin. I think that Chris Dixon, who's the king of mental models, explains quite well. Was listening to his podcast the other day on Bankless, which somebody internally, our head of strategy, she's a brilliant woman as well. I'm grateful to work with her. But I listened to this podcast probably like 5 or 6 times just because some of the ones that really stand out, they help create the foundational thinking. Web 1, from what Dixon said in his mental framework, it democratized information. Web 2 really democratized publishing, which I know is very close to your heart and everybody at Real Vision. But the issue with Web 2 is the value accrual really went to the Web 2 platforms and those that allowed us to interact like that, not as much to the creators. But for Web 3, it's democratizing ownership. I think that that's a really clear and concise articulation of the differences. So Web 3 is actually very reminiscent to Web 1. So what we see here on the next slide is that the private capital markets need digital transformation. There are 3 cardinal sins with the private capital markets currently. The first one being poor capital formation. Only 300,000 accredited investors in 2018 participated in private capital market formation when there were almost 14 million accredited investors that were eligible to do so. Think about even those that are qualified to do it per regulation, maybe they just aren't aware or comfortable enough with what's going on. And then when you look at those that aren't accredited investors, meaning that they have a pretty substantial net worth and or a high income per year versus retail, which is really the average Joe and Jane, their participation in private capital market formation, so investing in startups and growth companies in early stages, is negligible. Private capital markets are also extremely inefficient and expensive. You can see the global annual costs for clearing and settlement, which I think we all know, looking at the blockchain and Bitcoin network, what it was able to help reduce when it comes to final settlement, which we've discussed before, Ash, on a previous episode when we talked about central bank digital currencies.
Hey, Mike, for folks who are coming to us from the tech side who might not have the experience that you do in the financial aspect of this, could you walk us through what clearing and settlement is and bank sales and trading, where those costs come from and how they suck margin out?
Yeah, for sure. I mean, the thing is that when you are in the financial markets, you're working with a bunch of different third parties and intermediaries and what you call counterparties. So who is on the other side when you're buying something, or who is on the other side when you're selling something? And there's a whole stream of third parties that are responsible for the record keeping, whether it be even internally between organizational departments to externally to the regulators to your lawyers, your accountants. All of these records need to be reconciliated. And that's where clearing and settlement comes in, along with what you have per securities regulation, which used to be T+3, I believe, which they've gotten down to T+2, which means your trade date, and then the settlement date is 3 days, 2 days, business-wise later. I believe the SEC just recently got it down to T+1, and then I think the goal is to get to where blockchain and Bitcoin are when it comes to transaction settlement, because the efficiencies that you have with blockchain networks, Bitcoin transactions, think about how quickly those settle when you're transferring money across that network. And sales and trading costs, obviously it comes down to commission, and for retail, those commissions have come down pretty significantly because of the innovation that we've shown on the first slide with something like Robinhood. Robinhood was actually the reason why trading fees pretty much came down to zero for retail traders. But here's the other side of that. Information flows. That's where businesses started to make their money, specifically with proprietary and high frequency trading. So there's always a shift in value accrual and who really gets that value. We believe that Web3 technologies allow for the democratization of ownership and value accrual.
I also wanted to touch on the third point on this slide, which is liquidity. For folks who aren't familiar, give us a bit of a primer on liquidity and why it's such a challenge right now in private markets.
Yeah, well, the thing is that private markets don't readily trade the same way that stocks that are listed on the New York Stock Exchange or NASDAQ, where anybody that has an internet connection and application can trade them because they are massively liquid, where they have market makers, and these networks and brokerages have been around for a very long time, where you can easily bring together buyers and sellers. That's really what liquidity is. How easy is it for you to trade in and out of this security and essentially get liquidity from a cash standpoint or go into another type of asset? With the private capital markets, you have to go seek out the buyers and sellers, or you have to essentially use what we have internally, luckily, is an alternative trading system, which we have the license for. And that's one of the things that the Securitized business ecosystem is bringing to the digital transformation of private capital markets.
So 2 points just for the background here. Number one, these challenges in liquidity aren't just about access in terms of the simplicity of trading. They're also price impact considerations, meaning when liquidity is very low, you have very wide bid-ask spreads. You have the inability to sell at higher prices and buy at lower prices. So it's an economic component as well. And secondly, the idea of ATS, an alternative trading system, is an incredibly important one because it's a regulated environment, similar to an exchange and from a regulatory perspective, but gives you the ability to trade actual securities, listed, registered securities in the United States.
Yeah, that's a great summary, Ash. I think that you're a master of your craft when it comes to conciseness. So I think that, looking at the Securitized business ecosystem and how the different pieces that we built out over the past 5 years are starting to come together, similar to what we saw with the FANGs over the past several decades, is they have complementary business lines and services that, when they're in the aggregate, create some incredible opportunities for their stakeholders. And that's how they're able to achieve parabolic user growth and revenue numbers. So looking at the business ecosystem that was created, right at the center, we have what's called Securitize ID. And that helps with investor onboarding, verification, and helping them manage stakeholders. So when you're looking for capital, you need investors. Most of them are institutional, and then a lot of them are accredited And then retail investors, again, don't have much access usually to private capital market opportunities. We want to help change that. And by creating a simple passport that can do all the necessary background checks to make sure that bad actors aren't engaging in activities in the private capital markets, we created Securitize ID.
So this is where you do your AML, KYC, anti-money laundering, know your client type of analysis, check for suspicious activity reports, and all those sort of things that traditional banks and brokerage houses do on the capital market side today.
Exactly. And we have it from a simplicity standpoint where it's a 4-step verification process. Honestly, you could do it in 10 minutes. It's quite simple. And the beauty is that you don't have to keep signing up for each individual investment that you want to look at. Once you have a Securitize ID, you can view everything that we have within our business ecosystem, as well as those ecosystems that we are connected with.
So Mike, today, is this for accredited investors only, or is it accredited and unaccredited?
No, actually, what's beautiful right on the slide there, we have retail investors, accredited investors, and institutional investors can all create Securitize IDs to access our platform. And the beauty of that is that it allows them to then come to Securitize Markets, which is the broker-dealer that we have, and it provides primary and secondary market opportunities where we can facilitate capital formation, so helping startups and issuers raise capital using regulatory exemptions from the Jobs Act, such as Reg A+, which is also known as a mini IPO. You can actually raise, now that the cap has been lifted, $75 million with a Reg A+. And that's something that I'd like to talk about later when it comes to a crypto company, a hardware and software wallet creator, Exodus. Our business ecosystem helped facilitate their $75 million capital raise. You can also use Reg Ds, which is the most common one for private capital markets when it comes to what's known as a private placement. And what's near and dear to my heart, Reg CF, or crowdfunding, since we believe that that business, now that the cap has been raised from $1 million to $5 million, will provide a fantastic opportunity for companies to raise capital from their communities and provide their fans and their loyalists with opportunities to access these companies and basically reward them for supporting them.
Mike, give us a little bit of a framework here. I know that you're a CPA. I'm not. Just give us a little bit of a framework for understanding the distinction between registered securities, exempt securities, private markets. How does that taxonomy flesh out?
Well, yeah. So basically, if you want to raise money in the private capital markets, you either have to have existing networks with the institutions and those that are the gatekeepers of capital, or you can basically go these other routes. The whole reason why the Jobs Act, Jumpstart our startups, was really created is to facilitate and ease the restrictions and the requirements for small to medium-sized businesses and startups to get the capital that they need to grow their businesses. There's a lot of legal fees that go into it and registrations with the SEC that they wanted to cut through some of that red tape. Think about the time that it was passed in 2012, right after the global financial crisis, where we were still getting out of the wake. And that's where the Jobs Act helped provide a methodology. And instead of having to go through all this paperwork and these regulatory disclosures, which takes months and months, and those legal fees, as we all know, can add up, this helps speed up and expedite those processes. And really, that's why we like crowdfunding as well, because there are ways where you don't really have to be bogged down, and in a compliant way, you can access these raises and get to the investors that you need relatively quickly. And what I think would be great, just for those that are in the weeds and technical, but we'll keep it high level. They can screenshot if they really want. This is our business ecosystem from a technical standpoint, which shows all the different parties that interact with it and how we're actually using Web3 technology to digitally transform the private capital markets. Now, when we say Web3 technology, again, the foundation of Web3 is blockchain technology. Think about also what comes from blockchain technology: smart contracts, wallets, so identity, the asset transfers across these networks, the ability to basically digitize and put a wrapper around securities like equity. That's what we can facilitate with our tokenization engine. And we currently interact with 4 wallets and networks that we really believe are going to stand the test of time when it comes to weeding out what networks will be there in 10, 20, 30 years versus those that might have just been, speculative pumps and dumps. We really like these 4 networks, which are Ethereum, Avalanche, Algorand, and Polygon too. We use them in our tokenization engine, and they're also the wallets that users interact with our platform. The beauty of it, though, is that it's all governed by the DS protocol, which is our proprietary protocol, DS standing for digital securities, and that's what makes everything regulatory compliant within the exemptions and restrictions that come along with private capital markets and securities. We can program transfer restrictions, making sure that those that bought these digital assets are those that are holding them, and that they can only keep them in their wallet and not send it out to the gray areas of crypto land. So essentially, we're using the wallets and networks and infrastructure that's been built out to modernize and digitize the private capital markets, specifically equity. So when you're bringing these technologies that allow us to modernize the networks and the assets themselves, along with the laws that have been updated or amended, like the Jobs Act, that's where it can become really special here. When you're bringing updated legislation and updated technology together to help create the facilitation of these capital raising procedures, which we see with our Web3 crowdfunding solution. The legislation is important. The laws of old need to be brought into the new, and that has dual meaning. Similar to the way that a constitution has amendments, the laws of today, and we're seeing these battles on Capitol Hill between the different regulators, they need to be updated for the capabilities of blockchain and Web3 technologies. And at the same time, they need to be brought into the new, meaning they need to be brought into the new system, into this new world, which is Web3. So we need a compromise in the middle, and we at Securitize are very supportive of regulators, of the lawmakers. We respect that. We respect these foundations that have been created. We're trying to help bring these foundations into Web3. If you look at what the Jobs Act allowed and how much money and capital was able to be facilitated to these number of startups using Reg CF exemptions, Reg A plus exemptions, and Reg D exemptions, it's pretty astounding that $10 billion was raised over the past 10 years. And that's just the start. If you think about the way that we're going to be able to now democratize the access to these opportunities with blockchain networks to those all around the world. And we can use these Jobs Act exemptions as a way to have the law on our side.
We were just talking a little bit off camera about an example of a tokenization deal that you guys did. Walk us through it.
Yeah, sure. Well, Exodus, which everybody in crypto knows Exodus, it's one of the wallet creators and the softwares that a way that basically those that are in digital assets, not only individuals but also institutions, can safely and securely hold their private keys, which is the way that they access these digital assets. So we help facilitate Exodus's $75 million Reg A plus offering. And we did that with Securitize ID, as well as our tokenization engine through our transfer agent. And it ended up coming full circle too when we were looking at one of the earlier slides with liquidity. It's actually a token now that the exemption period has expired on our alternative trading system. And that's really a home run when you look at helping facilitate a way where you can get $75 million that you need to grow your business, but also reward your community members as well. Because you can see here how important that was to JP Richardson, the CEO of Exodus, providing them an opportunity not to give Wall Street and the fee hungry, bankers and lawyers the money, but allowing these opportunities for those that have supported them, because the vast majority of those that participated in this Exodus Reg A plus offering were actually retail investors, which is pretty incredible. That's very special. It's helping spark a movement toward community-based ownership. So when you are able to reward those that use your products and services, they're going to go out and be the biggest evangelist for your business or your network. We've seen this in crypto. We're very active on crypto Twitter. Ash, we're both a part of the global fellowship or community we have here. A lot of these are just concepts and brands. And think about how fanatical people get about these tokens. It's actually pretty astounding from a sociological standpoint. But now, if you're able to do this for tangible products and services, think about how much more you're going to get from a network effect as well as a user effect. And that's what Exodus helps spark. And that's actually a great place to run into what we have, a special preview here.
But before we talk about that, I just wanted to ask you some questions about some of the potential risk factors here. You've talked about some of the advantages that the platform that you guys are working on now creates. Let's talk about some of the risk factors. Obviously, when we talk about these community effects, there's the potential for this irrational exuberance to form in these markets that are less liquid, that seem to be more prone to boom and bust cycles. When we talk about retail investors who are putting, their hard-earned money at stake, how do you guys think about that, setting a framework where they can understand the risks as well as the potential rewards that they're looking at with these tokens?
We at Securitize take our stakeholders, investors, especially retail investor interest at heart. And that is why we use the regulatory exemptions and frameworks, and we follow them to the T of the law to provide all the necessary disclosures to all investors. That's why we actually do the KYC and the AML, to make sure that those that can afford to access are those that are accessing. We also have on our platform accreditation restrictions where, depending upon what exemption people are using to raise capital, only certain accredited investors can actually access these. Otherwise, if you're not an accredited investor, and it might be too risky of a category per the regulatory frameworks, you're not allowed to buy it. But if it's something where, say, Reg CF basically is available to all investors, including retail, there are also limits on the amount that they can invest. depending upon their income or their net worth. So we follow that to the T of the law because we are regulated by FINRA as well with our broker-dealer. We have a fantastic compliance team in-house. We have a great legal team. And all of this is programmed into our platform as well as the assets that people interact with.
So you mentioned the risks. What might some of those risks be, and how do you think about them? We're talking sort of about the suitability to investors of different types of investments. What would some of those categories of risk be for folks who are trying to get their head around what private markets do and what some of the risks are there?
Oh, well, those types of risks are everything that would be outlined in what you call a private placement memorandum, a PPM, or specifically with Reg CF, you actually have what is called the Form C. So everything that could potentially go wrong, similarly to any company where you look at basically their prospectuses or their 10Ks and 10Qs, you have all those sections where it's basically everything. It's like one of those lines where you see like in a pharmaceutical commercial, and they have all the risks of what could potentially happen from a side effect standpoint. And that is something where you get those types of risks with every single time that you're allocating capital somewhere. There's always a risk that the business risk of the individual firm or even macroeconomic risks that are out there. But these are all things that are well disclosed. And what's great about the Reg CF type of disclosures is that they are very narrative based, because that's a requirement when it comes to the frameworks that were put into place versus quantitative, just so that everybody, no matter what type of investment sophistication they have or knowledge sophistication, it can be in an easily digestible format.
Let's move on to the next slide.
Right here we have a special treat. So we actually have, which is going to be next week, and I'm not sure, I think this is going to air probably that week or maybe the week afterward. What we have here is going to be our first Reg CF issuer on the platform, and it's called Security Token Market. You've probably seen them on crypto Twitter. These guys are fantastic. They have great personalities, and they basically provide data and analytics and market coverage for this digital asset securities market. And what they were able to do using our Web3 crowdfunding platform and our broker-dealer is they could test the waters, or basically measure the potential investor interest before even starting their raise. And
how do they do that, Mike?
Yeah, well, what they're doing is basically getting a temperature check. So you can see here we have a simple 4-step process where they're going to go out to their networks, their communities, their followings, and it all in a regulatory compliant manner where they clear it with us as well as the regulators. They announce to their networks, hey, we're intending to raise capital. And once they do that, they have a registration of the intent to invest. So basically they go out to their networks and they have others out there say that, okay, we're interested in potentially funding your business. And that's where a user comes to our platform and they create a Securitize ID as well to get onboarded. Once they've confirmed that they are interested, it's just a temperature check. It's a way to basically take a poll of your community, of your investor base, of those that might potentially be interested, and see would they be interested in this opportunity. So what was, from an astounding standpoint, STM was able to get 6.2 million in pledges from over 1,000 investors within a 13-hour period. So instead of having to go through right away all of the paperwork and disclosure documents and legal filings, you can, for a fraction of the cost, just see or project how your capital raise might do. And if that temperature check didn't go well, then your opportunity cost is so much lower versus going head first without any data. So the next slide here is really special in that it shows the sauce, what's very unique about our Web3 crowdfunding platform. We're using these networks and smart contracts, and specifically the hashes from the private keys, to conduct atomic swaps of whatever digital asset security an investor is going to be buying with USDC, the stablecoin. And that transfer, in similar to an atomic swap matter, goes from the investor's wallet to the escrow and custodian wallet, all within one transaction on the blockchain, while at the same time signing the subscription agreement. That is unheard of from an efficiency standpoint. Instead of having to use third-party applications and software, you're killing three birds with one stone at that point. You're facilitating asset swaps as well as signing a legal document, all within one transaction on the blockchain.
So let's do a quick jargon alert there on atomic swaps. Give us a quick definition for people who don't know what that means.
It's just an instantaneous transfer. That's really what it is, of one asset to another. So instead of, we have these T+2, T+1 settlement periods, it's just an instantaneous transfer where there's no counterparty risk, because basically it's being released the second the other one is being released, and they both arrive at the same time between wallets. So this is kind of the conclusion right here. This is the overall vision of what Web3 crowdfunding will eventually become and can help facilitate. And I like to say that Web3 crowdfunding is a methodology for entrepreneurs to raise capital from their community using Web3 technology to further the expansion of Web3. So we're looking for legitimate use cases for these blockchain networks, these smart contracts, these wallets, outside of speculation. And we have it here. We're using these networks like Polygon, like Avalanche, like Ethereum, to digitize equity and debt, and to facilitate capital raising processes to allow for community-based ownership, the digital transformation of the private capital market fundraising process, as well as secondary liquidity, and capital raising just in general. As we said in the beginning, digital transformation is really needed in the private capital markets. What do we get from this? Increased access to the private capital markets. We'll be able to allow the retail investor, the average Joe and Jane, to get into potentially the next Airbnb, the next Apple, the next Facebook at an early round stage, versus being the exit liquidity of early stage investors and venture capitalists. That is revolutionary. We're also looking at potentially the redesign of organizational and network structures, making them more cohesive and flexible from an interoperability standpoint. Overall objectives of Web3 crowdfunding: increase inclusiveness, empowerment to entrepreneurs and their communities, the development of networks, services, and organizations, as well as user growth. Again, the world is awash in capital. Capital is a dime a dozen at this point, but getting users is one of the hardest issues with network growth, especially in the early stages, which I think Chris Dixon has a great mental model for that. That's actually where tokens come into play with a lot of the open source blockchain networks. It's an incentive structure. But if you're able to raise capital and get users at the same time, it really is a home run. And the final outcome, By using this Web3 technology to help bring the laws of old and the frameworks into the new world, as well as increase users and the adoption of wallet addresses, private keys, educating the public about these technologies, that is what will eventually lead to mass adoption, similar to what we saw in the early days of Web 1 and Web 2.
Mike, I really appreciate you coming out and walking us through what your shop is doing over at Securitize. Obviously, all the old investment verities still apply, not financial advice. Please do your own research and consider your own investment objectives. And it wouldn't be a bad idea to talk to a professional to understand a bit about your own risk tolerance and how you need to think about your own investment future. Really interesting stuff, Mike. I especially appreciated walking through some of the structure of the way private markets work, some of the challenges as well as the opportunities that exist there, some of the risks and potential rewards. Thank you so much for joining us again on Real Vision.
My pleasure, Ash. We're really grateful for the opportunity. And anybody that wants to learn more about Web3 crowdfunding, be sure to go to securitize.io.
Thanks for watching, everyone.
Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.